Good afternoon and welcome to Rehmann's 2021 Governmental GAAP Update, presented in association with the West Michigan chapter of the AGA. My name is Ashley Pearson and I will be your moderator. Our webinar qualifies for 2 hours of continuing professional education, or CPE. In order to receive CPE credit for attending today's program, you will need to respond to at least 5 of the 6 separate questions that will be provided during the webinar. Participants requesting CPE credit will receive a certificate via email within 7 to 10 business days. Today's program is being recorded and will be placed on Rehmann's website within 24 hours. You will be able to access it by going to rehmann.com/government resources. That's rehmann.com/government resources. If we are unable to answer any questions during the program today, we will follow up with you via email. Additionally, after today's program, questions may be sent to the presenter via email at publicsector@rehmann.com. That's publicsector@rehmann.com. Please stand by for a moment while we begin the recording process. Our speaker today will be Stephen Bland. Stephen is the Education Director for the West Michigan chapter of the Association of Government Accountants and is a principal at Rehmann, where he serves as the firm's Director of Governmental Audit Quality. Stephen is a CPA and a certified government financial manager with 25 years of experience in the governmental and nonprofit arena. He is also a member of the AICPA's Government Audit Quality Center Executive Committee. Stephen, you may begin the presentation.
Thank you so much and welcome everybody. Glad that you're here for our 11th or 12th now annual Governmental GAAP update. Honestly, as I was looking at preparing for this, I was a little nervous that we were going to not have enough new content, but as we get into it, you're going to see it's actually been a busier year than you might have expected with all of the COVID-19 things going on. We're going to follow a similar format to our normal annual GAAP update. We'll talk about standards that were issued a while ago but became effective over the last year. We'll talk about the new standards that were issued over the last year and the things that are still a little ways out on the horizon. And then we'll give you at the end just a quick overview of what's coming in terms of exposure drafts, preliminary views, things that haven't yet hit the final standard area yet. We could easily fill a 2-hour webinar with the GASB's ongoing projects, but we're going to focus on things that are going to hit a little more close to home for now, and we'll save a future update to get into some of those future projects. So what were the new standards that became effective in 2020? Well, what's interesting here is only 4 standards became effective in 2020, and in all of those cases, it was because they were deferred from the past. These are all things that would have been effective and actually got kicked back because of the pandemic. So GASB statements 83, 84, 88, and 90 all had new effective dates that fell either in summer or the end of the calendar year of 2020. And they were all caused by a very unusual thing, which is a statement issued in 2020 and that became effective immediately. GASB 95 at the end of our list was the postponement of the effective date of certain authoritative guidance. Basically, every outstanding GASB that was not yet in effect got kicked back another year, or in some cases 2 years. We'll talk about that when we get there. So a few of these are familiar tunes. We've been over them before. We'll move through those quickly because we've covered them in the past. But if you hadn't already implemented them, they became effective in 2020. Looking ahead to statements that will become effective soon, but we're already on the books, the GASB Statement 87 on leases actually got kicked back the furthest of any. That got an 18-month extension, which sounds exciting until you realize nobody has an 18-month fiscal year end. So either you got an extra year out of this, or depending on your fiscal year end, you might actually have got an extra 2 years out of this. It either rounds up or down. Nobody gets an extra 18 months. So June 30 of 2022 is now the new effective date for leases, which sounds like a really long time off. We'll touch just briefly on that standard again. We've done a really deep dive in the past, and I don't want to rehash a lot of that old material, but I do want to just quickly refresh you on the major points and maybe whet your appetite for going back and rewatching the detailed presentation if you need to. GASB 89 was one of those that got postponed along with all the rest. It is such an easy standard. It tells you to stop doing something complicated and make life simple. So I can't imagine why anyone would choose to take the extension on that, but it's an option. And then GASB 91 was fairly new when we talked a year ago. It's still pushed out now until the end of 2022 on conduit debt obligations, but we will take a few minutes and walk through that because it's still fairly complex and we want to make sure everyone's on the right page. Now, look at all of these new standards. In addition to GASB 95, which was just a postponement, there were actually 5 new standards that were issued for real in 2020. So the first one, the omnibus standard, was just a series of small updates, no big deal. We technically were given a lot of time for those. I don't think there's much of anything in there that you wouldn't choose to just implement and move on. But some of the other new standards, 93 on the replacement of interbank offered rates. 94 is a huge one on PPPs and APAs. We'll talk about that near the end of the presentation. 96 on subscription-based information technology arrangements, or SPITA, as that acronym gets pronounced sometimes. We'll talk about that. It's basically plugging a hole that was left open in GASB 87 on leases. And now that GASB 87 is kicked out so far, I think there's a real opportunity to just implement those 2 standards together since they're very, very similar, but we'll talk about that. And then GASB 97, we've got some time on it, but it also is designed as a fix for an existing GASB, in this case, GASB 84. And so I don't think there's any reason to wait on implementation of 97. It again makes life easier for you once you've implemented GASB 84. So enough overview. Let's go ahead and, well, I'm sorry, it's not quite enough overview. I should have paid attention to my own next slide. One last thing here, and that is there was the normal implementation guide issued during the year. No major issues there. We'll briefly touch on it later. And then there were 2 things that we're not actually talking about today that were COVID-19 specific. They were issued in 2020. There was a technical bulletin in June and an emergency toolbox in July. Actually, at our last quarterly webinar, we did a deep dive on both of those on governmental accounting and auditing in a pandemic. And if you're interested in those, you can go back and rewatch last quarter's webinar to get the details on those. Now, without further ado, let's hop in to a recap of some of the older standards that got pushed into 2020 through the extension process, just to make sure we're all on the same page. GASB 83 on asset retirement obligations basically was having you book a liability now for things that you know might be coming with long-lived assets. And while it was originally effective in 2019, that was pushed into the summer of 2020. Now, it doesn't cover landfills and it doesn't cover pollution, mostly because we already have separate standards for each of those. But it is intended to pick up examples, things like decommissioning a nuclear reactor or disposal of wind turbines or wind farms, or taking apart and removing sewage treatment plants, or getting rid of an x-ray machine from a hospital. You know, the kinds of routine things that governments do every day. I say that tongue in cheek, obviously. The bottom line with this standard is, if you have a large capital asset, and if you have an expectation that that asset will at some point have to be decommissioned as opposed to just maintained in perpetuity, and the decommissioning is going to have some costs with it, then what we're left with is something that meets the GASB's definition of a liability. So let's look at how the GASB has defined an asset retirement obligation. Do you have a legally enforceable liability? That's going to mean some sort of requirement that's tied to maybe environmental regulations, some kind of legal requirement that someone can hold you accountable for, that you're going to have to do this. It's similar to what we think of with landfills. At the end of the useful life of a landfill, there are post-closure care and monitoring costs that have to be incurred, and so governments book a liability for that. Well, we already had that kind of guidance for landfills, but it didn't extend to other types of assets like the ones we just listed. So this kind of fills in and mirrors some of that gap. So when a tangible capital asset, a plant, a physical piece of equipment is going to be retired, that is permanently taken out of service, including whether you sell it or just walk away from it or recycle it or throw it away. But we're not going to count temporary idle status. Like, it's not just that we're not using it for a few months or even a year, we're done with it. Then if we have an obligation to spend money to safely dispose of it, that liability is going to go on the books. So how does it go on? Well, on full accrual financials, meaning enterprise funds, internal service funds, and government-wide statements, you'll book that obligation, that liability, as soon as it's been incurred and it's reasonably estimatable. So when is it estimable? Well, it's estimable when we can put a dollar amount to it. When is it incurred? Well, that's when an external obligating event has occurred, meaning there's a law or regulation passed, or there's a contract you've signed, or there's a court judgment somebody external can make you, or there's an internal obligating event, such as the law was already on the books, but it didn't apply to us until we put this asset in service. So in that case, the act of putting the asset in service could be the obligating event. If you're just using the asset up, or if you don't have any obligation until you stop using it, well, the actual act of stopping using it, the abandonment, could be what triggers it. If you're just thinking ahead, you know what, I think I'm probably going to stop using this water treatment plant or this sewer plant in about 5 years. That's not enough. The actual walking away from it is when the obligating event would then occur, not just planning to retire it. Unless, of course, the law is already in the books, in which case the obligating event may have already passed. So what do we book? Well, we book our best estimate of the current value of the outlays that are expected to be incurred. So how much is it going to cost in today's dollars? I know I'm not going to actually spend it for 10 or 15 years, but how much in today's dollars would it cost to do that? Now, you might say, I know pretty much what it's going to cost, and you're done. You might say, I don't know, it could be a little bit, it could be a lot. There's a lot of factors I just don't have the information on. And in that case, we use a probability weighted average, where we say there's a 15% chance it'll be little and an 85% chance it'll be big. And we multiply those percentages and amounts out and come up with an estimate. If you can't come up with a range of estimates and you say, here's my most likely outcome, you can go with that as well. Basically, that obligation needs to be offset at the beginning with a deferred outflow, and then that deferred outflow gets amortized over the asset's life. Essentially, we don't want to recognize the cost all at once. We're kind of sort of depreciating and amortizing it, only it's a liability. So rather than capitalizing and depreciating, we're going to book a liability, defer it, and then amortize it over its useful life. The only exception to that would be if you have an asset, it was construction in progress, before you ever used it, you decide to abandon it, well, then there is no useful life. At that point, you just have to expense it all and get it over with. In the full accrual financial statements, you're also going to annually adjust your estimates. If you're still using the asset, run it through the deferred outflows. And if you've already retired it and you've already should theoretically recognize the expense, run it through expense in the current year. In a modified accrual fund, of course, we're limited to what we're using with expendable available resources, basically book things as they come due and payable, like we always do in governmental funds. There's a series of things that need to go in for note disclosures, basically describe that you've got an asset that has certain obligations related to it that you have to pay. What are your methods and assumptions used in estimating the dollar amounts? How many years do you think you've still got before this comes up? And maybe you've set aside assets. Maybe you've got restricted cash that you're putting in reserve so that when these costs come, you're ready to pay it. If so, disclose that. If for any reason you say, I know there's going to be a cost, but I'm just not estimable yet, I can't even get good cost information, then just note disclose that it's not yet feasible to come up with a cost estimate, and one will be reported in the future. So GASB 83 has some meat to it, but I don't know that very many of us are going to run into it in practice. Most of us just don't have assets that have those kind of obligations associated with them. With that, we're going to take a pause for our first CPE prompt. And we're asking where you're joining us from today. And on my screen, I see the options are home and the office and or other. And I'm thinking my home is my office and also my other. So I need an all of the above. Can you give me one of those guys? All right, as we get those answers coming in, we will go ahead and move forward. Actually, we did have a question I'll try to answer quick. The cost to demolish a power plant, should that be an operating expense or below the line? Well, that's a good question. So in a proprietary fund where we actually have operating and non-operating costs, the cost is going to first be deferred and then it's going to be amortized over time. And that would be an operating cost. The argument is that what we're trying to do is the same thing we do when we capitalize an asset. When we capitalize an asset, we say, I'm spending money today, but it's going to benefit the future. This is the tail end of that. We're at the end of an asset's life cycle and we're paying money, but it all was benefited in the past. So by amortizing that over the useful life of the asset, we're basically recognizing this is a cost of operating this asset. And so it would be an operating expense as we go along. Great question. All right, let's move on to GASB 84. And I'm not going to go into a lot of detail here because we have dedicated an entire webinar to this. It sounds like a really long time ago. It was back actually the fall of 18 that we did this. This standard's been on the books for a while. We've known it's been coming. Its effective date was supposed to be the end of 19. It's been pushed to the end of 20. So this is the year everyone will have implemented it if they didn't already. So let's talk through what this standard does in brief, and know if you need more information, there's a recorded webinar you can go back to. In brief, it identifies and creates a new category called fiduciary activities. And I would argue it spends as much time telling you what fiduciary activities are not as it does spend telling you what they are. So a lot of things that we've historically kept track of in agency funds that no longer meet that definition, that's a big focus of GASB 84. And it also changes the financial statements for those fiduciary funds that remain. So just a few quick highlights. As a reminder, in our government-wide financial statements, we report governmental activities, business type activities, but we don't report fiduciary activities. Well, GASB 84 introduces the term fiduciary activities, but it does not change that reporting. We're still going to have a column for governmental, a column for business type, and a total, and there's fiduciary is not going to show. So why did they call it fiduciary activities? Well, what they're getting at is they're saying a fiduciary activity is something a government may do and work with, but it does not involve the government's own resources. It's not their own money. And so we need to determine what those activities are that are fiduciary in nature. We're still going to account for them in funds, but we need to make sure that they are excluded from governmental and business type activities. So they've given us a complicated definition. I wish they just gave us a page that said, what is a fiduciary activity? Here we can define it. Instead, they gave us 3 separate paths that we can go down. You'll know an activity is a fiduciary activity if it's either a fiduciary component unit or it's a pension and OPEB arrangement other than a component unit, or it's an other fiduciary activity. And unfortunately, even item 3 on this list has 3 subpaths underneath it. So it's a complex definition. Let's very briefly remind you, and then we'll move on to another standard. Under the first path, fiduciary component units, what makes something a component unit is set by GASB 14 as amended. It's been updated a bunch of times. Remember, those are legally separate organizations, and the primary government is somehow financially accountable. That can come 3 different ways, either by appointing a voting majority of the governing body and imposing its will, or barring that, appointing a voting majority and having some kind of financial benefit or burden, or if they don't appoint a voting majority, maybe the organization is fiscally dependent, meaning they have to play mother may I on a lot of fiscal matters, and there's a financial benefit or burden. None of that's GASB 84. That's just normal component unit stuff. And so you have to start with, in order to be a fiduciary component unit, you have to be a component unit. So go to the normal process of determining, is it a component unit? If so, then pension and OPEB plans that are administered through a qualifying trust, those would be fiduciary component units. Or pension and OPEB plans that are held for other governments, but they're not in a trust, those would be fiduciary component units. And then there's other fiduciary component units as well, and I've got another slide for that. Here, this is unrelated to pension, but it's held in a trust. It's for the benefit of individuals, or it's for the benefit of other organizations. And the rules for each of those are complex. There's a series of standards you go through. I'll show you in a minute. There's a flow chart. That's really the only way to make GASB 84 make sense, is to work your way through the flow chart. And as I said, we've got another webinar that does that in far more detail. The second of the 3 paths, assuming you're not a component unit, you might still be a pension and OPEB plan if you're administered through a trust, but somehow didn't meet the definition of a component unit. Now, the GASB will tell you they think that's rare. They think that if you're a pension and OPEB plan and you're in trust, they feel you likely will be a component unit, unless, of course, board appointment is an issue where maybe it's an independently elected board. So then maybe you're not a component unit, but you're still in a trust. Then the question is, does the government control the assets? And if so, you would report it as a pension and OPEB fiduciary activity. Finally, and this is where most of us will spend most of our time, set aside component units, set aside pension and OPEB plans. What else can governments do that would be considered fiduciary? Well, here we have to meet all three of these criteria. The assets have to be controlled by the government. That means held by or have their use directed by the government. Number two, the assets can't be something that government generated on its own. It can't come from your own source revenue or from some sort of a grant, like a government mandated or voluntary non-exchange transaction. So it can't be grant money. It can't be own source revenue. It needs to be other people's money. And then finally, you have to meet one of these three. You notice a trend here. I keep having three different options. In addition to the first two criteria, you have to meet one of these three sub criteria, which is either it's in trust, the GASB loves trusts, or it's held for individuals, but the government's hands off on administrative and direct financial involvement, or finally, it's held for outside organizations that are not part of the government's reporting entity. You'll see that option 3B there is really the most complex of all of them, the one that has the extra rules about no administrative or no direct financial involvement. Basically, the GASB is trying to limit the number of situations where a government is managing money on behalf of people, and it's really a government program, just under a different name. If you have administrative involvement for individuals, it's probably not fiduciary. It's probably a government program at that point. If it's in a trust, fine. If it's held for organizations rather than individuals, we won't get worried about the administrative and direct financial involvement criteria. Again, lots of steps on a flow chart, and you're going to want to go there. So those flow charts will basically tell you there's a lot of things that used to be in agency funds that are now going to move to either a governmental fund or a proprietary fund. It doesn't mean it's not a liability necessarily, but it might be a liability of a different fund. And so you're going to have to walk through the flow charts and make sure that you come to the right conclusion there. Now, on one of our later GASBs, when we go all the way up to GASB 97, we're going to talk about a recent amendment to some of this that makes life a little more interesting for defined contribution plans like 457s and 403Bs and 401As. So stay tuned to the end when we'll talk about that. If you've determined you do have a fiduciary fund under the new definition from GASB 84, those four fund types are listed here. What used to be called agency funds are now called custodial funds. And that's not the only change. They didn't just get a new name, they now have an income statement. So you're going to have a balance sheet and an income statement, and you can even have net position in custodial funds, which is something different than we've had in the past, and it's going to take some real thinking. And so if you haven't yet implemented this one and you're working through it, I encourage you to take a look at the flowcharts and the other guidance we've done. So real quick, wrapping it up, the extended deadline is now 12/31/2020. Implementation might have some impact on your budget if a fund needs to be, or if activity that used to be in a fiduciary fund is now in the general fund or a special revenue fund. There may be some budgetary impacts. Because of the way our custodial funds will now have an income statement, you may need to do some tweaking to your accounting software to keep up with that. But the bottom line is there is no one size fits all answer. Even in our other webinar, we gave a lot of examples, but you're going to need to walk through it on your own and see what makes sense for your government. That brings us to our second CPE prompt. And we're curious, how long have you been attending these webinars? So is this your first time, or have you joined a few, or are you a frequent attendee, or are you one of our veterans who comes every quarter, whether you need it or not? Go ahead and check your box and let us know. All right, we are nearly through the old standards before we're getting into the new content. So let me very quickly remind you of some of the details on GASB 87 for leases. Again, this is another one that we've covered in depth. There's a whole freestanding 2-hour webinar devoted just to this topic. So we're going to move real fast here to just kind of refresh your memory. Under the new GASB Standard 87, which will now be effective in June 30 year ends for 2022, all right, early application is absolutely allowed, but that's the earliest it's going to be required now. A lease has been redefined. We used to have operating leases and capital leases, and that's all gone. Now a lease is simply a financing of the right to use somebody else's underlying asset, and it's all under one model. We're now booking a lease asset and a lease liability, and it's going to be a little different than we've seen in the past. So here's the official definition. A lease is a contract that conveys the control of the right to use another entity's non-financial asset as specified in a contract for a period of time in an exchange or exchange-like transaction. Lots of words there. What's the breakdown? Well, we need some sort of a contract or an agreement. We need to be conveying the control of how an asset gets used. It needs to be a non-financial asset, so it can't be an investment or something. It needs to be for a period of time. So leases only work. In fact, all the lease accounting only works if you can figure out what that period of time is. And it has to be in an exchange or exchange-like transaction, meaning if you have one of those leases where it's 99 years lease for $1, that's clearly not an even exchange. You're not giving up, you're not getting something of value for what you're giving up. We're talking about things where you're paying an actual market rate or something close to it. So do be careful more about the substance rather than the legal form. It doesn't necessarily have to be called a lease, but if the contract meets the definition we just talked about, it's a lease. If you have a contract for services, that's not a lease, but sometimes they're so integral. You're leasing this equipment, and as part of the deal, they provide free maintenance. Well, I didn't specifically pay extra for the free maintenance. It's not like I separately priced it. I can't really easily identify how much of my lease payment is for maintenance and how much is for the lease. In that case, they say, fine, just treat it as all one. If you can tell the difference between the two, then you should be splitting them out and looking at the lease separately from the other piece. Now, this standard excluded a whole bunch of things. We're not counting anything intangible, including software. Now, that's going to get fixed with GASB 96. So as I mentioned before, there may be some value in implementing those two standards together, just so you've got one set of rules that you're following for everything. And there's a whole other list of things that don't get picked up, including service concession arrangements, which we'll talk briefly about that with the PPPs and APAs that come later, and conduit debt arrangements. Basically, the GASB said anything that they've got another project working on, they'll address separately, but they did want to go back and pick up older contracts. So in order for a lease to get valued, you're basically going to take all the money you're going to pay over the term of the lease and discount it to today's dollars. That's the liability. I have a non-cancelable lease I'm going to be paying over the next 30 years. I need to take 30 years worth of payments, discount them to today's dollars, and call that my liability. Or I'm going to be leasing this building for the next 5 years. I need to take those payments for 5 years, discount them to today's dollars, and call that my liability. But here's the problem. What if I don't know how long the lease is going to go? What if the lease is kind of a rolling lease that could go whenever? It could end at any time. We don't really know. It makes it much harder to book a liability. So what the GASB has defined the lease term is, it's the non-cancelable period. And to that, you add periods where you have the option to extend if you say it's reasonably certain you will. And you also include periods when you have the right to terminate as long as it's reasonably possible you won't. So that's a fancy way of saying, give me your best guess of how long this lease is going to go. And that's really the answer that we're going to land on. If both parties can terminate at any time, or both parties have to agree to extend, that's a cancelable period. It's a rolling lease. So I'm in a lease, but I've got really no contractual obligation. Then there's really no liability to book. The reason we're booking a liability is because you have a contract that says you're going to pay money over the next 5 or 10 or 15 or 30 years. If you didn't have a contract that told you had to pay that money, there'd be no liability to book. It's only because you have that non-cancelable period that there's something to record. So rolling month to month, don't worry about it. Now, what if the total period of this grant is very short? The maximum lease term is 12 months or less. In that case, the liability does not have to be booked because it's all current. We're only looking at long-term pieces. So if you're in a rolling or month-to-month lease, the non-cancelable term is considered, or the maximum possible lease term is considered the non-cancelable. So maybe you've got a thing that says, oh, you can cancel at any time on 3 months notice. Well, that's it. You have a 3-month lease. The fact that you can cancel with only 3 months notice, that's your obligation. It's under 12 months, we won't book anything. So we've gotten all that stuff out of the way. There's one more major exception. A contract that automatically transfers ownership at the end. The GASB said, I don't care what they call it. They may call it a lease, but if at the end of the lease, you automatically own the asset no matter what, no additional payments required, it's just yours, then it wasn't really a lease. It was a purchase. It was a contract that transfers ownership. In that case, just treat it like a financed purchase. Don't even call it a lease. Just act like it was an installment purchase contract or an installment purchase note. It's just regular debt at that point. It's not a lease. The lease guidance is intended to focus on you are buying the right to use someone else's asset for a period of time, and when it's done, it's not yours anymore. That's what a lease is. Let's pause there and take our third CPE prompt. All right, we're looking for your current role in your organization, and I'm glad we do have other on here because I know it's always hard to make titles work. Governments are great for having two people do almost the same job at two different governments with completely different titles, so I'll be curious to see the results of this one. While we're waiting for people to answer, I will tackle a couple of questions that have come in. So one question on tax collection, which has historically been a trust and agency activity, is that still a fiduciary activity? And the good news is, at least as that's implemented here in Michigan, that is absolutely correct. You are collecting, local governments are collecting taxes on behalf of other organizations, not individuals. And so none of the other rules really matter there. And the good news is the way that's structured in Michigan, there's an obligation to remit payments after a certain period of time automatically. So the accounting is, as it comes in, you're still going to be booking an asset and a liability. You're also booking a revenue and expense for the inflow, but it's great that taxes in particular had the smallest possible change. A lot of other areas are more complex. And so again, I'll encourage you to go back and check the other webinar. A question came in about materiality on leases. The question is, does materiality come into play? The answer is materiality always comes into play. And I actually have a slide on that, so stay tuned. All right, very, very briefly on leases, and then we're going to move on to our other new and exciting standards from this year. If you're a lessee, you're going to book a lease liability. That's the obligation of what you're going to pay in the future, and a lease asset, which is really your intangible asset for the right to use. The building you're leasing might be worth $5 million, but you're only leasing one wing of one floor for 5 years. The asset you book is much smaller because you're booking an asset that matches the liability you signed up for. Whatever 5 years worth of payments looks like, discounted to net present value, that's your liability, that's your asset, you're done. On the other side, if you're a government leasing to others, you're going to book a lease receivable calculated the same way, and then you're going to offset that with a deferred inflow of resources. And so as a lessee, you're going to have a liability and an asset, and they're both going to whittle themselves down over time. As a lessor, you're going to have a receivable and a deferred inflow, and they're both going to whittle themselves down over time. Either way, your balance sheet is largely grossed up in equal and offsetting amounts at the beginning, and over time, they both work their way down to zero. One may get there a little faster than the other, but they'll both arrive at zero at the end. So the way we calculate the lease liability, if you're a lessee, or the lease receivable, if you're a lessor, it's the same number, is you take the present value of all the payments you're expecting to make for the lease. So all the fixed payments, this is $1,200 a month for 60 months. All of the variable payments that are tied to some sort of an index, you use the current rates as they are today and value it and just call it good. Anything that is an optional payment that you think is reasonably likely to happen. So residual value guarantees. At the end of the lease, when you turn it back in, it's kind of the equivalent of when you lease a car. If you go over miles, they want you to pay a little extra for it. If any of that's in there, you can build that in. If there's a purchase option, it's not automatic because that would have made it a transfer that conveys ownership or transfers ownership. But if there's an option, ask yourself, am I likely to execute it? If so, throw it in. If I know I have to lease this for 5 years and I pay a penalty to get out early, but you say, secret, I know I'm gonna cancel after 3 years and just pay the penalty, then bake that in. Make it a 3-year term with the penalty paid. Just use your best guess at the time of inception or the time of adoption of the new standard if you're going back for old leases, and take those and come up with a net present value. Now you might be saying, hang on, how do I come up with a net present value? What am I going to discount it at? Well, you're either going to discount it at the rate actually charged. So if you're the lessor, you know the rate you charged. If you're the lessee, maybe they'll tell you and you'll know what it is. Or if for whatever reason you can't come up with that rate, then you can just use your incremental borrowing rate. What would it have cost you to borrow the money to buy it instead of lease it? In future periods, then, you just recognize either an outflow, meaning interest expense if you're a lessee, or an inflow, interest revenue if you're the lessor, as you amortize that discount over time. So very straightforward. It's honestly, the accounting is almost exactly like what you would do if you capitalized and depreciated the asset. You're just putting the asset on your books and you're recognizing the amortization over time, and you're recognizing interest expense over time, and they balance each other. On the lease asset side, measure it the same way as the liability. So once you calculate what you're going to pay, that's the value of your asset. Now, sometimes there might be some extra payments at the beginning, that go back and forth, in which case you'll have to adjust the asset based on those. There might be a cash incentive or something that gets deducted, but otherwise they're going to match 99 times out of 100. And then you just depreciate it. They're going to call it amortized because it's technically an intangible asset instead of a tangible asset, but it's depreciate. It's the same thing. Make sure you do that. Now, if you are expecting to purchase the asset, then the period over which you amortize it should not be the period of the lease. It should be the useful life of the asset. But otherwise, it's just the period of the lease. So if you're leasing a building for 5 years, heck, if you're leasing land for 5 years, land is normally not depreciable, but you're not buying the land, you're leasing it for 5 years, then you would amortize over that 5-year period. If you're the lessor, your deferred inflow matches the receivable at the beginning, adjusted for any lease payments that are received up front. And then you amortize that over the course of the lease on a systematic and rational manner. That's also code for divide by the number of years. Straight line amortization is really straightforward. All right, that's about all there is to it. The underlying asset, if you're the lessor, you don't take it off your books. You keep accounting for it and depreciating it just like you would, unless for some reason you have a contract that makes them return the asset in as good a condition as they got it. That's pretty rare, but in that case, then you would not depreciate. In governmental funds, basically, when a new lease comes around, you're going to have a capital outlay expenditure and other financing source, just like you borrowed the money and bought an asset. You're just going to run it through as an inflow and an outflow, and all your lease payments flow through as debt service payments, principal and interest, just like they would for any other debt. Lessors are going to book a receivable and an inflow in the funds the same as they do in government-wide, and then as money comes in, they're going to debit cash and credit the receivable, and over time, they're going to recognize the deferred inflow. So essentially, you're earning your lease revenue over time. It's just recognizing the interest. There's a bunch of note disclosures. These are only a smattering of them. There's more to it than this, but if you're the lessee, basically you're going to disclose what leases are out there, the dollar amounts. You're going to break down what's essentially a depreciation schedule. You have the choice of either putting it in the capital asset schedule on separate lines or just having a whole separate schedule for it, but you do have to keep them discrete from true capital assets that you own. So there's the ones you own, and then there's the ones that you are leasing. They just have to be on separate lines, either in one table or two. If you're a lessor, describe everything and then show the amount of inflows recognized during the year and disclose any termination provisions. And then if you have any of these other odd items, subleases, sale leasebacks, those all have to be disclosed as well. And if for any reason you're a government that says leasing is what I do for a living, then there's even more information with 5-year schedules that go in, but for most governments that won't be relevant. If your lease has a bunch of things kind of mixed together, like a lease and a non-lease component, a service component, do your best to break them out and account for them separately where possible, but where it's not practical, the GASB says it's okay to just call it all one and treat it as a lease. So what are some quick takeaways on the lease standard? Basically, you're going to have an offsetting asset and a liability if you're the lessee, or an offsetting asset and a deferred inflow if you're the lessor. Your existing leases may not match exactly the numbers you already have on your books. So for example, if you already have a capital lease on your books, you may have the fixed asset on your books today, and you may have the liability in your books today. And when it's time to implement this standard, you're going to recalculate future payments, call that your lease liability, and match the asset to it. You may actually have a small write-up or write-down from the implementation of the standard. It's not likely to be big, but it could happen. There shouldn't be any major changes to your budget statements other than you are now going to need to make sure you budget for new leases as an inflow. Otherwise, the capital outlay that you book could put you over budget on capital asset or capital outlays. But to our earlier question that came in, never forget the 12 most important words of any GASB statement. The provisions of this statement need not be applied to immaterial items. So what's materiality mean in the context of leases? Well, we're already used to the idea of putting a capitalization threshold on our assets. We only capitalize assets over a certain threshold. A similar thought process could and should be applied to leases. So encourage governments that have not yet adopted the standard, give some thought to how you're going to do that. It's one thing to not book assets because it's to the good, but when we start thinking about not booking liabilities, we get a little nervous. Well, if you have, hundreds of thousands of dollars or millions of dollars on your books with bonds payable, and now you've got a photocopier lease for $3,000 or $4,000, is it a big deal that it's not capitalized and shown? Would it be okay to say that's just not material? That's not a decision I can make for you, but I think auditors are going to be understanding that materiality matters, and these smaller items are something you need to take a hard look at. By the same token, if you go out and enter into 1,000 leases all at once for 1,000 laptop computers at $2,000 a piece, and it doesn't sound like that much money until all of a sudden you step back and say, wow, collectively, that was $2 million worth of leases. Well, maybe now you're saying collectively it is material. So that's a judgment call and something you'll want to talk through internally and with your auditors. All right, that brings us to our fourth CPE prompt. Are you still there? Wow, we are getting really specific on some of those. I hope you are. I hope you're still with us. All right, so this, we're almost to the end of the standards you've heard about before, and then we're going to get into some newer ones. GASB 88 was originally supposed to be effective in 2019. Most people, I think, actually had implemented it. It was technically pushed back into the summer of 2020 to give people a little extra time if they hadn't already. So what were the new requirements here? It's not that big of a deal. GASB 88 gave us a new definition of the term debt. And as part of that definition of debt, we were also given some new disclosure requirements. So this is not the definition of a liability, mind you. This is the definition of debt for disclosure purposes. Debt is a liability that arises from a contractual obligation to pay cash or anything else in lieu of cash in one or more payments to settle an amount that was fixed at the date the obligation was established. Wow, the GASB loves to make things complicated. So basically, debt is you have an obligation to pay something in the future and an amount that's known now. It's different from, say, pension and OPEB, where we're constantly estimating. It's different from leases because there was a separate standard one GASB ago to deal with that. But it's going to include things like bonds and notes and installment purchase agreements and just the normal stuff we think of as debt. So what are the new disclosures required? If you have a line of credit, then you need to disclose the amount that you haven't yet drawn on it. Obviously, the amount you currently have outstanding would already be on your debt schedule. If you have assets that you've pledged as collateral for debt, you need to make sure that you've disclosed that. And then if you have outstanding debt, any kind of significant terms related to what happens in the event of default, what happens if you terminate early, what would cause the debt to be due sooner. If you have any of those things, disclose all of them. And then here's the real trick. You need to separately disclose two different types of debt. And so they went through this whole process really with this in mind, to say we've defined what debt is and what debt isn't, and what are you going to disclose and how it's all going to work. And now we want you to separate two different types of debt, direct and other. Now it begs the question, what is this and why does it matter? Direct borrowings or direct placements of debt are debt that did not go through some kind of a public bid process. So usually when a local government issues bonds, those bonds are offered for sale on an open market, people bid on them, and in the end, you find out what rate you got on your bonds. Direct borrowings would be when you've gone directly to a financial institution or a specific lender. Maybe it's the state. Maybe you've gone directly to your state and said, I'm borrowing from a revolving loan fund. You didn't go through some kind of public placement. It was a direct placement. And it's not saying it's good or bad or it makes any difference other than we have to separate and list those individually. So as a general rule, and this is just a general rule, bonds are probably not direct placement. Most bonds are pushed through publicly. Notes payable, installment purchase agreements, those are probably direct placements. Excuse me. And so we're going to just need to have two separate, either an extra heading inside the notes or two separate tables. We need to be able to make it clear which debt is which type, if it's a direct or other. And that's really all there is to it. All right, so our next question that just came through is, hey, what about unused lines of credit? Would that include credit cards? That's a great question. So is a credit card technically a line of credit? I think we could make the argument that credit cards are technically a line of credit, but I'm going to go back to those 12 most important words of materiality. And I would guess in the case of most governments that the outstanding credit line is expressed in small enough dollars that it's not really a material disclosure. If it makes you feel better to say the government maintains, government issued credit cards for routine purchases with an outstanding credit limit of collectively, $100,000. That's fine. If you want to disclose the amount available at year end is going to be something less than that, that would be fine. Is it a big deal? Is it material? Does it really get to the level of impacting your debt coverage ratios, the degree to which you have exhausted your ability to borrow? My guess is no, but that's a judgment call you'll have to make. Good question. All right, we're on to GASB 89. Super simple statement that you're going to love because it just makes life easier. Most of you will remember that in college we had this really complicated thing of capitalizing interest incurred during a construction period. I borrowed money to start construction. Construction takes a year. During the course of that year, I'm paying interest. I haven't yet put the asset into service. So really that interest is not a normal borrowing cost. It's part of the cost of building the asset because it takes so much time to build the asset in the first place. And so there were all these complicated rules for when you were allowed to and when you weren't allowed to capitalize interest during construction. The GASB didn't want it done in governmental activities because that went contrary to their concept that interest should not be allocated. And if as soon as you put it in an asset and assets get depreciated and that does get allocated, it was a whole thing. So only enterprise funds did it, and it was a pain. And the GASB finally took a look at it and said, you know what, we stand by the technical accuracy of this, but there's always a trade-off between what is technically correct and what is efficient and just worth it. And so end of the day, they said, it's not worth it to do this anymore. So they have eliminated interest capitalization. It's prospective. So if you already have assets on your books that already have interest in them, you don't have to go back and find it and pull them out. Just leave them alone. Just stop doing it. That's really the whole standard. You could take the entire standard and boil it down to 3 words. When it comes to interest capitalized during construction, stop doing that. And that's all there is to it. It's technically not required to be implemented till the end of next year, actually the end of this year, 12/31/2021, but it's really easy to implement. Just do it and move forward. Or in this case, just don't do it and move forward. All right, our next standard is majority equity interests, GASB 90. This one just became effective for 12/31 year ends, and that was the extended deadline. This is going to be a very rare standard for most routine governments. This is where a government has an interest, an equity interest, an investment in another entity, a legally separate entity. I'll tell you where I see this most frequently, and it's in tribal governments. Tribal governments may own gas stations or restaurants or things. They also own casinos, but in most cases they created them from scratch, but they may buy an existing business. Local governments could fall under this as well, but it's just not common in practice. So we're going to define what a majority equity interest is and tell you how to account for it if you have one. I think most of you are going to look at the definition and say, doesn't apply to me, and that's fine. So a majority equity interest starts with having an equity interest. Before you can know if it's even a majority, let's see if it's even an equity interest. It means that you own a financial stake in a legally separate organization, and that is evidenced either by stock or some other explicit measurable right to your resources. So stock ownership would be one way. They may not be organized as a corporation. Maybe they're organized as something else, but an explicit measurable right. I know that I own 22%. I know that I own 65%. I know that I own 17% of this organization. It's usually based on an investment of either financial or capital resources. You paid for it. This is not the sort of thing you just happen to stumble upon. Usually it's because you bought it. Sorry, there we go. Now, if that majority equity interest, well, first of all, you know it's a majority equity interest because it's over 50%. So we take an equity interest, make it over 50%, now it's a majority. So if it's an investment, then you're going to report it as an investment. Well, how do I know if it's an investment? Well, there's a whole standard on that. GASB 72 defines an investment. Why do you have this equity interest? Is it mostly to make money? Okay. And is its value to you mostly based on its ability to make money? Then it's an investment. don't record it as a component unit, report it using the equity method. The equity method says I own 65% of this entity and it's worth $100, therefore I own $65 worth. That's the equity method. Every year, find the value of the entity, multiply your ownership percentage, book it, and move on. If it's not an investment, then you should evaluate, is it a component unit? We're right back to GASB 14, the normal definition of a component unit. So are you financially accountable for it? Do you have the ability to appoint board members, or do they have to get your permission to do things? Can you set their rates? Can you impose your will? All those different steps that you walk through to ask that question. And then, so if they're a component unit, report them as a component unit. And then you also need to report your investment in the majority equity interest using the equity method. So report it as an asset. So it can actually end up in both places. It can be a component unit and an investment, which is a little strange, but that's the way they want it reported. So some fund or some department, some activity owns it, book their investment there, and then also show it as a component unit if it's a component unit. It may not be. What if you own it at 100%? Well, if you own it 100%, then follow GASB 69 and say it was actually a combination. It's not even a function of an equity interest. At that point, it's just part of you. So don't worry about it. All right, that's it for that one. We are ready for our 5th CPE prompt. Ooh, have you engaged in any of these trending quarantine hobbies? I'm liking it. Baking bread, and I've not done that. Home projects, I do a lot of those. Jigsaw puzzles, my wife has done quite a few of them. TV is always an option. That's not pandemic, but a lot of people have done that. New hobbies during the year, excellent. Well, record those answers. All right, and now conduit debt obligations. This standard is not actually going to be effective until the end of 2022. So we've got a little bit of time. And this is when one government is handling resources, or is actually responsible for debt that's held by another organization. They're a pass-through of that debt. They're not ultimately going to be responsible for paying it directly. And this standard makes it really clear. Most governments were accounting for this right, in my estimation from what I've seen, but there was apparently some confusion nationally. And so this clarifies that if you're a conduit, you're only secondarily responsible, that somebody else is really making these payments. Then if it's truly that kind of conduit debt, then it's not a liability that belongs on the issuer's books, and they just note disclosure it instead. So let's see if we can walk through and decide. How do you know if it's a conduit debt obligation? Well, there has to be at least 3 parties involved. There's the issuer, the government that actually issued the debt. There's the third party obligor, so that's the government or other party, may not be a government, could be another business or a nonprofit, who's responsible for paying it, and a debt holder or trustee who's managing this, the person who was borrowed from. So we could say technically our government issued some kind of debt to this third party, and then there's another party who's actually paying for it. So the issuer and the third party obligor can't be within the same financial reporting entity. So it's not considered conduit debt if it's the county and one of its component units. If it's the city and its DDA, that doesn't work. Those are within the same reporting entity. If your audited financial statements contain the other entity anywhere inside the report, then you're in the same financial reporting entity. It's not conduit debt. So don't worry about that. There's also a couple of weird transaction types called parity bonds or cross-collateralized debt. That essentially makes it so that the issuer is the obligor at that point. And so in that case, it wouldn't really be conduit anymore. So we're not talking about those situations. The debt proceeds, who gets the money, actually goes directly to the third party obligor, not the issuer. So I've seen situations here in Michigan where a county issues bonds, collects the money, builds some sort of capital asset on behalf of a local unit, and then the local unit pays the county back and the county pays the debt back. That's not what we're talking about. This is a situation where, just to use that same example, the county, it's technically in the county's name, but the proceeds bypassed the county, went straight to the township, and the township is the one who is responsible for repayment. In fact, the county isn't even listed as the primary obligor. They're not responsible for making the payments. This wasn't even done for their full faith and credit or to get their credit rating. So it's different than the situation where maybe a county or a city, it could be anybody, but I'm just using a county as an example, where they are the primary issuer and they're doing it for the intent of getting the best credit rating. This is where they're just being a pass-through. I'm helping out. And a lot of times this happens not where it's on behalf of another government, it's because it's on behalf of some kind of business. Maybe it's an economic development kind of operation where a government is eligible for a certain kind of borrowing, and the business who's the beneficiary, this third-party obligor, they're not eligible to borrow the money directly. They have to go through a sponsoring government. And so that's just how it's the program set up. And so they borrow that way. So the issuer, that's the government involved here, has made a limited commitment to issue tax exempt, to maintain the tax exempt status. We do this because only a government qualified. And so typically that would be done for some kind of for-profit type entity, maybe even for a nonprofit. But legally, they're assuming no responsibility to make debt service payments beyond what is collected from the third-party obligor. They are not putting their own full faith and credit out there. So that's going to exclude a lot of relationships and agreements right off the get-go. There may be additional commitments or voluntary commitments of its own resources. That's fine, but it does not have a legal obligation to pay more than what they actually collect. So additional commitments could be where the government says, I'm going to step in because I feel like I have a moral obligation, or I've given a financial guarantee, or I've pledged assets, or just that they've decided to step in and cover payments voluntarily. If those sorts of things happen, then we would be in a situation of needing to book a liability. But if it's just the limited commitment, this starting limited commitment, then you're going to book no liability. But if an additional commitment or a voluntary commitment was made, if the government said, I didn't have to, but I chose to do so, then you would book a liability. You need to annually evaluate the likelihood that the debt service payment would be made by, will be stuck, that the government's going to have to make a payment. They're not supposed to have to, but if they're going to have to, then you have to annually evaluate what's the likelihood and book the net present value. So essentially, this is a liability that should have never been on your books. There is one set of circumstances when you should put it on your books, and it's because you think, even though you don't have to, you're choosing to cover for them. And if that's the case, if you're stepping in and saying, that's not my obligation, but I'm going to cover it, then you would have a liability that you need to book. There are also a variety of other arrangements that could be associated with these conduit debt obligations, things tied to the construction and acquisition of a capital asset. In that case, the issuer may retain title to the asset. So technically, you could say it's not, the asset belongs to the government that issued this conduit debt, and the payment schedule all kind of lines up with that. In those cases, even though it may be styled as a lease, they would say it's not actually a lease. Don't use lease accounting. Follow this standard for conduit debt. But you do have to double check service concession arrangements. That could be an interesting one to look into from GASB 60. So what do we end up doing? If the issuer releases title at the end of the arrangement, then it's not really yours. It's yours in name only. You don't book a capital asset. You don't book the debt. You don't book a receivable. You basically book nothing. It's going to be a disclosure. I've got an arrangement where technically the asset's mine, but I never actually plan on using it. I don't even have custody of it. You do nothing. If the issuer retains title at the end of the agreement, so at the end it's all done, it becomes your asset, then you don't book an asset or debt or receivable until the end. And then when it becomes your asset at that point, that's when you book it. Because who knows what might change between now and then. So you would book the capital asset only at the end, because in the meantime, you're not having the benefit of the asset. The asset is being held by and used by this other party until the agreement's done. And then at the end, you would book a donation for the acquisition value at that time. If the issuer retains title and the third-party obligor has exclusive use for portions of the building, then that's different. Now you actually got an asset that you're getting some use out of. There you would book the asset, but not the debt or the receivable. So there's a whole lot of options you have to work yourself through here, facts and circumstances, and make sure that you're following how you're actually structured for your particular arrangement. Regardless of all of these, no disclosures are the main focus. So describe the conduit debt obligation. What is the limited commitment? What's the balance outstanding? That's the big trick with these. So a government that issued these debt 10 years ago and is really not responsible for anything. You're not even making the payments. Someone else is making the payments directly. You're still technically, you need to be tracking how much is outstanding to be repaid so you can note disclosure. So what is the outstanding balance? And then if you've made voluntary commitments, then you'd want to disclose what those are, describe any liability that was booked. And if you had to pay on their behalf and expect them to pay you back, then you need to record that as well. So hopefully this doesn't come up a lot in practice. I had a question come through. Would this sort of conduit debt accounting apply to taxes? So a government collects taxes to be distributed to a local school district for debt collection. No, there's no, in this case, there was no debt issued in the name of the tax collecting government. The debt would actually be in the name of, a school district in that case, and the taxes are just being collected by someone else. So that's not a conduit debt obligation. Does not fit. All right, the omnibus standard that was issued in 2020 at the beginning of the year, just before the pandemic, it's a lot of little technical corrections to existing GASB standards and to implementation guides. It's now technically not effective until June 30 of 2022, but these are all corrections to existing standards, and it's one of those that I think by and large, they'll just get implemented in real time as they are really viewed as corrections to the related standards. I looked through the list here, and it's a lot of little unrelated stuff that I just didn't feel we needed to spend a lot of time going into detail on here. But if you're interested, this standard is certainly available. Let's talk about GASB Statement 93. This one's interesting. It's about interbank offered rates, and that is an interest rate used in certain contracts, loan agreements. The big reason this standard was issued was because of LIBOR. So a lot of things used to be tied to the prime rate, and then in more recent years, a lot of things were tied to LIBOR, the London Interbank Offering Rate. And LIBOR is actually being phased out. By the end of 2021, it's not supposed to exist anymore. Well, that's not a big deal. Contracts that were tied to it can just be changed to some new rate, some other index rate that can be used. But this standard doesn't become effective until June 30, 2022, even though LIBOR ends in 2021. So it's going to be a stretch if you don't implement this when LIBOR falls out from underneath, if you have any contracts that are tied to it. It's really only relevant for those governments that have derivative instruments that were considered effective hedges under GASB 53. Now, if when I just said the words derivative instruments and effective hedges, you said the what now, then there's a good chance GASB 93 doesn't apply to you. If you're that, oh, I'm listening, I'm interested, then for those governments, let me just quickly remind you that there are certain types of contracts that governments might enter into that have variable rates to them. And the reason we've entered into those variable rates is that we're trying to hedge against a particular risk. We're not talking necessarily about investments. Investments are intended to be volatile. They go up, they go down. We're just trying to make money on them. We're talking about hedging derivatives where maybe we are purchasing heating fuel and we're buying futures on it in order to keep the cost manageable. Well, heating fuel costs go up and down over time, and the futures for heating fuel costs go up and down over time. And the idea is if you have purchased a derivative instrument to hedge against that, while one goes up, the other goes down, and it kind of gives you a little more smooth. It's sort of the equivalent of trying to synthetically convert variable rate debt to fixed rate debt by buying a swap agreement. And that swap agreement is intended to smooth out the interest rate. You have variable rate debt, and it's high and it's low, and it's high and it's low, and your swap agreement goes the other direction. And in the end, when you add the two together, you get a nice smooth interest rate. The idea behind an effective hedge is it takes volatility out of the financial statements. And GASB 53 gave us the option to treat effective hedges just that way, to not have to run it through the income statement for all the ups and downs, to defer and offset any effective hedges with a deferred inflow or deferred outflow, and it keeps the income statement smooth. One of the provisions of GASB 53 was if you have a hedge and that hedge ceases to be effective, then you have to book a big gain or a big loss, and that's a pain. No one wanted to do it. One of the things that would have made a hedge ineffective is changing the rate from, say, LIBOR plus 2% to something else. And when LIBOR goes away, everybody was going to be kicked out. So the GASB basically wrote a standard that says LIBOR is going away. It's not your fault. If you're taking an existing effective hedge and converting it from what it was, LIBOR, to something new, whatever that may be, then we will give you this one-time pass that you can continue your effective hedge accounting. So if that made sense to you, great. This is a standard that saves a problem that might otherwise have happened. If it doesn't make any sense to you, don't worry about it. The standard didn't apply to you anyway. Here's one of the new big ones, GASB 94, public-private partnerships, public-public partnerships, and availability payment arrangements, or PPPs and APAs. Now, at the time the GASB started working on this project, PPP sounded like it was a safe acronym that people were using. Since then, of course, we have the Payroll Protection Program. That's a completely different PPP, has nothing to do with this PPP, so don't mix those two up. So this is taking the guidance from GASB 60, service concession arrangements, which we have talked about briefly today, just mentioning it. And it builds on that, saying service concession arrangements were part of a much larger universe of contracts. If you don't recall, because GASB 60's, it's been a while, GASB 60, service concession arrangements, talked about situations where a government outsourced the operation of major infrastructure to another entity, usually a for-profit company, and usually for a big upfront cash payment. So the classic example would be privatizing toll roads. So a state government says, I've got all these toll roads and they bring in some money every year, but we're really strapped in our general fund. How can we get some cash? I don't really need the toll roads. I need them to be operated properly. What can I do? I know. I'll go out and I will sell the right to operate my turnpike for the next 20 years to a company and have them give me cash up front and then just tell them, you run the turnpike for the next 20 years and you can keep all the money that you raise. We're just going to set some rules and regulations about how the minimum standards you have to follow. But if you think you can run it more profitably than we can, feel free. In the meantime, I get a bunch of cash up front. And so the local government, or the state government in this case, under GASB 60 was told, well, you just got a huge windfall by selling all this stuff in the future. What do I do with it? Well, what I do with it is I defer it and I amortize it over the life of that contract. It's a 20-year contract. I got $20 million of cash up front. I'm going to recognize $1 million of revenue per year over 20 years. There's a lot more to it than that, but that was briefly what service concession arrangements are all about. It's where a government partnered, usually with a private enterprise, to run some sort of government thing. It's not the same as a sale, because I didn't sell the turnpike. The turnpike's public infrastructure. I probably can't even legally sell it if I wanted to. And I still have some say in how it gets run. I can still put laws and regulations around how it's going to be handled, but I'm going to have somebody else handle all the details, and they're going to keep all the money. So we're going to now broaden on that guidance and say service concession arrangements were a subset of PPPs. And then APAs are another type of arrangement that is different than a PPP, and we need to define both of them. So if your head's swimming with acronyms, great, you're in the right place. Let's walk through it. So a PPP, a public-private partnership, or sometimes a public-public partnership, which just means two governments working together instead of a government and a for-profit business. But I think you can assume public-private is the norm for most of these. So a government is the transferor. They have some sort of non-financial asset. Now that non-financial asset is likely big, is capital, is probably infrastructure, but it could be equipment, but it's usually big infrastructure. It's going to be a stadium. It's going to be a road system. It's going to be a prison system. It's going to be a university dorm system. I've seen a lot of different flavors of this that get done different ways. And the biggest example that I've seen dollar-wise, I think, was a dorm. So a university said, we're going to turn over the administration of our dorms to this third party, and they're going to give us a bunch of cash up front. And then over the next many years, 50 years, they're going to charge and collect for the board payments, room and board payments from students, and they're going to run everything, and we're going to let them handle that. That's their job. We basically privatized, but for a term. So that was the kind of thing that would be transferred. So a government transfers something to an operator. The operator is probably a for-profit business, but again, it could be another government, to provide some kind of public service, that's something that a government should be doing, by conveying either the control of either the right to operate or use a non-financial asset. It's got to be for a period of time. These things tend to be many years, and it's got to be an exchange transaction. Money is changing hands. There's going to be some sort of regular exchange there. Now, it includes service concession arrangements. Those are the ones with the large upfront payments, or they could be installment payments, or sometimes instead of getting cash upfront, they say, you know what, if you build a new stadium for us, we don't have a stadium, but for-profit business, if you come and build the stadium, we'll let you run it for 30 years. And at the end of 30 years, we own it. That could be the payment, is that you get a free building 30 years from now. So it could be a service concession arrangement, but it wouldn't have to be. PPPs can include things that don't meet that definition, where there's the large upfront payment. It can also meet the definition of a lease. If it meets the definition of a lease, the PPP it's still a PPP, but now you follow GASB 87. So they say, just look at it and see if it's a lease. We like the lease rules. They're recent. We just came up with them. Go ahead and follow those. If it's a PPP, it'll be fine. Okay, let's go to the next one. An availability payment arrangement. Now in that case, this is where a government is compensating an operator for services that include designing, constructing, financing, maintaining, or operating an underlying non-financial asset for a period of time in an exchange or exchange-like transaction. Now, the difference here is, instead of giving them the asset and giving them control of the right to operate the asset or the control of the use of the asset, instead, they're compensating them for either designing the asset or maintaining and operating it. But they haven't taken over the control. So a good example in my hometown of Grand Rapids, there is a government agency, the Kent County Grand Rapids Convention and Visitor or Convention and Arena Authority. I'm getting that acronym wrong. But anyway, they own the hockey arena where the Grand Rapids hockey team plays. And so it's a government-owned building, but there's a for-profit business that manages it. They serve as the operator. Now, they don't have a PPP kind of arrangement where they say you have the full control and right to operate it, and you've paid us for that. In fact, it's the other way around. Instead of having a for-profit business pay for the right to use something and get to keep all the money, instead, that for-profit operator gets paid to run it for them. The government remains in control, and they pay them for a percentage or some sort of contractual fee. So how do we handle APAs? Well, with a PPP, we're going to look at service concession accounting and get all this money up front and book an asset and amortize it over time, or it's going to be a lease and we're going to book lease receivable for what we've leased to them over time. But with an APA, the money's actually going out the door. We're paying them. And so if we're paying them for designing an asset or constructing an asset or for the financing costs of an asset, well, all of that is really kind of like buying an asset. That's really part of the cost of the asset that we should be booking. It's our asset. It belongs on our books. And so those get added as a financed purchase. So if you're paying someone to design a building, well, that cost of those architecture fees, for example, get added to the cost of the building. So you paid them a service and now it's just capitalized. Oh, all right. So basically we went through a long path to say, keep doing what we're doing? Yes. Now, if they are maintaining or operating the asset for you, so you've privatized not the whole thing, you just hired them to be a management company to come in and run it for you, then you just expense it as you're being paid. So again, we're kind of back to, so really we're doing what we're already doing. Absolutely. So let me see if we can come up with some examples. We've got the arena example where a management company is hired and they handle staffing events, they handle maintaining the facility, they handle all those arrangements, and they get paid a fee for doing a job. That would be one example. Maybe a school district hires somebody to maintain their buildings, and so they've outsourced their custodial fees. The school still owns the buildings. The school still controls the use of the buildings. They've just hired someone to maintain them for them. Then you just call that maintenance and operating, and you expense it every year as it's incurred. So these definitions are really just there to provide structure for how these kinds of arrangements should be organized, and really it's not a massive change into what we're actually doing. GASB 95, we've already alluded to it. It was one of those rare statements that was issued and effective in the same year. It was issued in response to COVID-19. It basically delayed everything by roughly a year, with the one exception being the lease standard that got pushed back a year and a half, or effectively 1 or 2 years, depending on your fiscal year end. All right, we're going to come to our last CPE prompt, and we've still got some more good material coming after that. Let's put up CPE prompt number 6. There we go. All right, who do we think is going to win the big game? This is technically being broadcast, so I'm going to say big game just in case the NFL is watching. I think they probably not, but that's okay. And there are a list of teams here that are theoretically football teams. I'm going to have to take our administrator's word for it because I do not follow professional sports. But hey, hopefully you're rooting for somebody. I believe the winner of the big game will be the snack and beer companies who make all their money us buying junk food. All right, let's talk about GASB 96. GASB 96 is the practical extension to GASB 87 on leases, and it extends the lease guidance into the world of software. And I think this is a standard that people, frankly, were clamoring for. Like, it's just very unclear, how do I handle that arrangement? So I'm going to take something simple, although it's not limited to this. Think of a local government that's paying a large sum of money to have cloud-based accounting software. Maybe you've got a really large ERP, enterprise risk platform. Maybe you've got just a standalone accounting package, but some of those things, so you're signing up for a 3 or 5 year software lease. It's fairly expensive. And the question is, should you be booking something as a liability for that? It's a 5-year contract, but we're paying it in annual installments, or we paid for it all up front and now we're amortizing into the future. GAAP was a little silent on this. We weren't really sure what to do. If we don't own it, it's not software. In the old days, probably from the beginning, software has always technically been licensed to us. But with cloud-based accounting, we really have subscriptions. We may not even install this software on our own computers. It may just be buying the rights to log into cloud-based servers and do everything on someone else's machine. So how do we handle this? Remember, GASB 87 had a long list of exclusions, and one of them was all intangible assets. In fact, GASB 87 only applies to tangible assets that you're leasing. The lease itself is considered an intangible asset, but the item that you're leasing had to be tangible to start with. So software wasn't included. GASB 96 takes 2 different standards and pulls them together to make a new standard on subscription-based IT arrangements. And that's really the key. Subscription-based means we are paying some kind of monthly, quarterly, annual subscription fee to buy the right to use software, not really purchasing it outright. The first of those 2 standards that we're pulling together is GASB 51. Now, if that number seems low enough to you that you forget some of the details, you can be forgiven. It was accounting and reporting for intangible assets. Well, intangible assets, it gave us the rules for internally generated software. It told us what we could capitalize and what we couldn't if we are writing our own computer software. And that used to be very prevalent. I remember back in the days when accounting software, if it was a lot of black screen, it looked like an old AS400 kind of terminal, and governments wrote their own. You might even have a dedicated IT department that could maintain and keep up with the needs. Over time, we've moved away from that, but even with the commercially available big software packages, you go out and get a large government package that handles everything. There may be a lot of additional costs where you're customizing the software, and the time and effort and resources that get invested into making software your own may be such that we've incurred enough costs that this guidance is really going to be useful. Now, if we were incurring all those costs and owning it outright, that'd be one thing. Maybe we could follow capital asset guidance and GASB 51 would work for us. But what happens when we're paying a lot of money to customize someone else's cloud-based software and we're just paying a subscription fee to it? How do we handle it? Well, the bottom line is it's lease accounting, but we're not going to call it that. We're going to call it subscription accounting. So instead of booking a lease asset and a lease liability, we're going to book a subscription asset and a subscription liability. But really, it's going to be the same kind of accounting we would do for leases, which means we're going to need to look ahead and say, do I have a period of time over which I am contractually obligated to make payments? Maybe it's a 3 or 5 year subscription term. And is there a cancelable period? Like here's a 5-year contract, but I can cancel after 3 years. Well, then it's technically a 3-year contract with the option to cancel. And then we have to decide, are we going to do it or are we not? And we can pick up those periods where we had the chance to cancel but choose not to, and we have to add the periods where we think we might extend. And so we're looking into the future just like we would with a lease and say, for this subscription, what's the time period that I think I'm going to make payments? We need that subscription period because it's going to be the basis for discounting those future payments. So if we determine the subscription period is 5 years or 7 years or 3 years, whatever it is. We're going to lay out all of the payments we expect to make during that time period, and then we're going to discount that to its net present value. What rate are we going to use to discount? The same as we would in leases. If there is an actual explicitly stated rate, discount using that. In the absence of one, we can use our incremental borrowing rate to figure out what amount to value that at. So that process is going to be very much the same as it is with leases. Now, we just had a question come in asking about when it comes to the implementation stage, when we're implementing this standard, is it backward looking? And the good news is GASB 96 is just like GASB 87. Everything is perspective. So it's all about looking at what, from the time I implement the standard, what am I going to pay from this point forward? So we never have to worry about where we are in the middle of an existing contract. You might be 3 years into a 5-year contract. All that matters is that there are 2 years left. We don't care how many years you're in. We only look forward. So from every agreement that exists as of the date of implementation, how many more years of payments are there? And then we discount those future payments to today's dollars using that discount rate. So the same as we do for GASB 87, looking forward only. Now, let's take a look at what things do and don't get included with subscription-based IT arrangements. There are 3 different stages of a subscription-based IT. And I have actually heard folks from the GASB call this SPITA. And I've heard the T sound like a T, and I've heard the T sound like a D, so SPITA or SPITA. And I think it depends on whether you're actually from Norwalk, Connecticut, and talk with that Northeastern accent, or whether you're a Midwesterner like I am with a heavy nasal accent. Who knows? But I'm going to say SPITA, and if you hear something other, just don't say SPIDO, because that sounds like something that we don't want to talk about. So the stages of a SPITA are the same as you would see with internally generated software. There's a preliminary project stage. That's where you're evaluating your alternatives. I don't know, what are we going to use for software? Do we want to go with vendor A or vendor B? Do we want a comprehensive solution, or do we want HR to have its own system that's separate and not worry about trying to fit it all together? Once we've picked the package, do I want to go with this vendor or that vendor to handle the installation and the customization? When you're in that preliminary project stage, you're still figuring out the answers to a lot of questions. The middle stage is called the initial implementation stage. And we call it initial because implementation for software feels like it never really ends. But during this time, we are making the necessary, we're incurring charges, incurring costs, and those are the things that are necessary to put a subscription asset into service. We're doing what's necessary so that we can get it ready. And I'll talk in a minute about some of the things that go into that. But while we're trying to get it ready, then those costs under the internally generated software standard, back in GASB 51, that's when it would say, go ahead and capitalize those. So that's the cost of writing software, or if the software is already written, that's the cost of modifying it, adding new features, customizing the interface, getting it to work the way you need it to, and getting it populated with the data that it's necessary for it to operate effectively. And then the third stage of SPITA is the general operation. And they threw in an additional implementation stage because they didn't want people to say, well, I'm still making changes. Like the GASB is like, yeah, you'll always still be making changes. Software is constantly getting updates. We can't let the fact that there will continue to be ongoing implementation stand in the way. As soon as the software goes into production, once you're operating, when it's substantially complete and usable, it's never done, but now you're into the operation and additional implementation stage. So I think in plain English, we could say the I'm getting ready to stage, the I'm working on it stage, and the I'm using it stage. But the official titles are preliminary project, initial implementation, and operation and additional implementation stages. So what do we expense and what do we capitalize? If you are in the preliminary project stage, if you are still evaluating alternatives, if you're still picking vendors, if you're incurring costs to watch demos or send people around to look at what other governments are doing, or maybe even paying for limited scope demos of software that you're not actually using in production, you're just checking them out. Anything during that stage, you're going to just expense it as it's incurred. Those are period costs. If you've gone into operation and your software is now being used, so the costs of any updates or things you're doing at that point, those subsequent activities, the maintenance costs, the ongoing operations, you're expensing those. And at any stage, any of those three stages, if you're training your people, the cost of paying external trainers to come in, the cost of sending people to training, all of that gets expensed as it's incurred. None of that can be capitalized. What we are going to capitalize is just the middle stage here, the initial implementation stage. The costs that you're incurring to get the asset ready for service, those we're going to add to the cost of the subscription. So what is the cost of the subscription? Well, the vendor is going to charge me $1 million a year for 5 years. But in addition, I'm going to spend $500,000 in the preliminary stage and $500,000 in the implementation stage and another $500,000 in the operation stage. So what do I load into my total cost that I'm going to discount? Well, I'm going to load in the actual subscription cost. And then to that, I will add only that middle phase, the initial implementation stage. So what kinds of things count? Programming absolutely counts. And this one surprised me way back when with GASB 51, and it continues to be non-intuitive to me. We can include the cost of paying a software consultant to convert or import our data from our old system into the new system. Here's the argument. An accounting system requires historical data to be meaningful. It requires the chart of accounts to be loaded to be meaningful. It requires a lot of the government's own settings and things to be loaded and to be usable and be meaningful. So because of that, all of those costs getting the software ready to be used can be counted and capitalized. What can't be is training. And I would have argued intuitively that, well, isn't the cost of training people to use it also necessary for it to work? And the answer would be, well, no, the software works. The fact that you don't maybe have people who know how to use it does not mean that the software itself isn't ready. So we're trying to separate the cost of the asset itself from the cost of your operations of the asset. So getting your data loaded in, getting the software configured, all of that perfectly fine, but the cost of training is not. So those are the little nuances where you're going to take the actual subscription costs, add the costs you've incurred just in those various, that middle category there, and then that becomes the total dollar that we then keep applying normal GASB 87 guidance. We're going to take all those costs, discount them to net present value, and then treat it like a lease going forward. The note disclosures will also be very similar to what we do under a GASB 87 lease. So it's general description of what the subscription-based IT arrangements are, the total amount of the assets, how much has been amortized. You're actually going to have more capital asset schedules, just like we've had before. So the capital asset schedules we have for a lease, it can either be a separate one just for subscriptions, or you can just add a line to your capital asset table. Just recognize we're now going to have actual assets we own, intangible assets, which are what we're leasing, and now subscription assets. They all have to be on separate lines. So that's the only difference there. We will disclose our interest and principal requirements to maturity. And for the purposes of GASB 88, which we talked about just a few minutes ago, this is not considered debt. So when we're trying to break down debt between direct and other, it does not include leases. It does not include subscriptions. It's just traditional debt items that have to be split out that way. So I'm sure there will be more guidance that we will get into on subscription-based as we get a little closer. For what it's worth, my 2 cents is I think most governments would be in good standing if they chose to implement 96 at the same time as 87, because it's just one more similar transaction and you could just be done with it. But it's really up to you. You actually have a few extra years on that standard. All right, a quick one for you here, GASB 97. This was a technical amendment to GASBs 14 and 84. While we technically have until June of 2022 to implement it, this is one that I'm going to recommend governments implement immediately, or at least with GASB 84, which at this point is now, everybody's fiscal year end is now passed for 84, because it tightened up the definition on certain fiduciary component units. So let's see if I can explain what happened here and why. GASB 84 had an implicit assumption built into it. It wasn't explicitly stated, but the GASB kind of approached GASB 84 with the thought process that if you have a legally separate entity, then clearly they have a board. And in their mind, the existence of a trust, a legally separate trust, meant a legally separate entity. So every pension, every OPEB plan that was in trust, well, that meant there was a legally separate entity. That's what the trust really was. Now, I have read, I'm not an attorney, but I have read a lot of things online that attorneys have posted, and I will tell you there does not seem to be a great degree of consistency in opinion on whether a trust is itself a legal entity or whether it's just a level of legal protection and the trustee is the legal entity. It seems to be a matter of some dispute depending on the context. So without weighing into that debate, let me just say the GASB answered that question by saying, for the purposes of evaluating component unit status, you may assume that if there is a trust that meets the definition of a legally established trust, that it is a legally separate entity. Fine. So forget the legal definition. For GAAP purposes, anytime there's a trust, it's a legally separate organization. Great. Now the question is, who is the governing body? Well, for a pension plans almost always have a governing body. Maybe it is appointed by the government who sponsors the plan. Maybe there are certain positions that are just ex officio. So the finance director and the mayor of the city are automatically on the pension board. Or maybe there is a process by which the government appoints certain members and the unions or the participants in the plan get to elect certain members. It just depends. But there's usually a board. And so we can go through the GASB 14 analysis. Is it a legally separate entity? Yes, GAAP tells us so. Who appoints a voting majority of the board? Well, maybe it's appointed by the government, maybe it's not, maybe it's independently elected by the plan participants. And so we can walk through this GASB 14 checklist idea of determining if they're a component unit. But if there isn't a board, then it became a little less clear. So I've got an OPEB plan. The OPEB plan was created and nobody really remembered to set up a board for it. So the GASB had said, well, gosh, if the primary government, somebody has to be in charge. So if this thing exists and no one else is doing it, it must fall to the primary government. So the primary government must be performing the board duties because somebody has to be performing the board duties. The duties of the board are to be in charge of governance. So who's governing the plan? In the absence of a board, it's the primary government. Great. So for purposes of GASB 14, let's just assume then if they're performing the duties, that's as if they appoint a voting majority of the board. Problem solved. In fact, the GASB had built that guidance in to a Q&A guide. They built that into the Q&A guide for GASB 84 a few years ago. The problem is we looked at this for some of the OPEB plans and say, well, there really isn't a board at all. And I don't feel like they're appointing a voting majority. And now all of a sudden we were seeing things that historically have not been in government financial statements being roped in. And the 401A, the 457, the 403B plans, essentially the governmental version of a 401k, were suddenly on the table. We were saying, wait a second, the government is not really managing these monies. So the government doesn't really have control of these monies. The money is being directed by the employee. These are employee directed investment funds. It's their money. The government's obligation is met as soon as they put funds aside. Why would we have to report this as a fiduciary? We don't control the money. And the GASB's answer to that would be, well, control under GASB 84 only matters if you are not a component unit. If you're a component unit, then we don't care. We never even ask the control question. That's why I told you earlier with 84, you have to go to the flow chart. If you try and keep all of the terms in your head, it's hard to remember which ones apply in which context. So if you're a fiduciary component unit, it doesn't matter whether you control, you're just, boom, you're in as a fiduciary fund. And suddenly it looked like these defined contribution plans that are really employee directed resources were going to have to be reported as funds. All right, fine, whatever. My government gets a copy of a statement from, whatever insurance company or whatever agency holds these employee resources. I can look up the investment balance and just throw it on the books. There you go. Total investments on the books. It's all held in trust for employee benefits. Done. I don't have to worry about it. Well, it's not so hard to account for it because you probably can get a summary statement and throw it on the books as a fiduciary fund. Your auditors, however, are going to have a dickens of a time trying to audit it because you don't control the internal controls over that. You don't have the general ledger detail for all the transactions that happened during the year. It's not nearly as easy to audit as it sounded. So the GASB has issued 97 as sort of a final fix to this. because what they said is if there is not a legally separate governing board, or if there's not a separate governing board, but the primary government has to fill in by default, treat it like they appointed a voting majority, unless it's a defined contribution plan or a non-contributory 457 plan. So basically, they pulled that rule out. So there's not a board. Therefore, if you're assuming you're a 401A, 403B, 457 plan, non-contributory. So now there's not a board. Therefore, the government cannot impose its will on that board. The government can't appoint a voting majority of that board. Basically, you're not going to be a component unit. Once you skip over the not a component unit question, then we ask, does the government control the assets? And 99.9 times out of 100, the answer is going to be no. We don't control the assets. We let the employees control the assets. Yeah, sure. We pick the 15 or 20 funds they get to choose from, but all the buy-sell decisions, all of the decision of how they're going to handle it, that's all handled by the employees. Control has not been maintained by the government. And so in those cases, we may very well find that those plans no longer meet the definition of fiduciary activities, which is good because we don't want to put those DC plans on our books. So the other thing we find is that the GASB 84 financial burden criteria only applies to defined benefit plans. So when you're trying to decide, forget the governing body thing, maybe that one didn't get us there. We're going to get stuck on the next one where we have a financial benefit or burden because we're making pension payments. So the GASB has said, if you are a defined benefit plan, then yes, there is a burden. The government has the obligation to step in and make payments. If you're a defined contribution plan, there's no ongoing financial burden because each year you meet your requirement by making that year's payments. So they closed two loopholes, one on board composition and the other on financial benefit or burden. And that will scope out a lot of those plans. Now, for Section 457 plans, it gets a little more dicey. In general, historically, a 457 plan was completely non-contributory, meaning it didn't even meet the definition of pension or OPEB. It was nothing. This was a voluntary withholding of employees' money. The government had no obligation to contribute anything, and therefore it was not a OPEB plan. It wasn't a pension plan. There's no actuarial stuff involved. We're just done. This standard clarifies that 457 plans have evolved since GASB 32 when this came out. It was a long time ago. We're talking 20 plus years now. And so now some 457 plans have become contributory. So the government may be matching or putting money in on behalf of employees. If so, if you go back to GASB 67, 68 and read the definition of a pension plan, it's likely that a contributory Section 457 plan now does meet the definition of a pension, in which case you just follow the normal guidance for GASB 67 and 68, which means you have to determine, is it defined benefit or defined contribution? If it's defined contribution, there's not much to it. Note disclosure, move on. You may be reporting the assets depending on how the control question shakes out. But if it's a defined benefit, meaning that it's a contributory plan and the government is like guaranteed an interest return or something. We guarantee you'll get at least 5%. Now it's a DB plan. It needs an actuarial valuation. It's the whole thing. So definitely look, talk with your auditors, talk with your actuaries, and determine, what do you have with your Section 457 plan? Is it technically a pension plan, or is it not, based on the presence or absence of employer contributions? So that's the big clarifying part of GASB 97. All right, there was a new implementation guide that came out in 2020. It's an annual process. They just go out and update various things based on questions that come in. I will remind everybody of kind of my annual news broadcast. The GASB gets Q&A guidance published based on real life questions. There's a place on the GASB's website, go to gasb.org. You can pose a technical question. It's a great form online because you get to say, what topic does it relate to? What's your question? What do you think the answer is? Is there anybody who disagrees with what you think the answer is? Share their thoughts as well. You can lay it all out and then you hit submit and you'll get a phone call, usually within 1 or 2 business days. Unfortunately, the GASB will not give you an answer in writing because they only do that when they go through formal processes like this. But if your question is good, it'll show up in next year's implementation guide. That's how we get them. So there were 21 new questions, clarifying GASB 14 and the reporting entity. One question clarifying external investment pools, where one government is holding money on behalf of other governments. Several on GASB 84 with fiduciary, several on leases with GASB 87, and the two new standards that are on the books but not yet implemented, GASB 83 with asset retirement obligations, and now the conduit debt obligations from GASB 91. There's questions for those. So that's available. We've talked about each of the questions kind of in place as we went along. And then there were 5 questions that they updated answers to for unrelated matters. Usually when that happens, it's terminology. They're not changing the answer from yes to no. They're updating terms because of some other change in another standard, just to make sure it's as current as possible. What's on the horizon? The GASB is expected to issue 4 things in 2021. We're expecting an exposure draft yet in January. We'll see if that comes out, but the technical plan says yet this month we should have an exposure draft on a change to GASB, gosh, is it 16 or 18? It's really old. Compensated absences, the liability that governments report for unpaid or unused sick and vacation time. Quick turnaround on this. They plan to issue the exposure draft in January and the final standard in December. So technically this will be another example of a standard issued and effective in the same calendar year, but that's when it'll be issued. It'll be effective future years. So we'll have some time on that to see exactly where they go. The ED is not even out yet, so I can't tell you for sure what the anticipated changes are. We are expecting in the second quarter of this year a new concept statement on disclosures. Concept statements don't set GAAP, but they do set the rules that future GAAP follow. So that will be an interesting one to watch. Try to decide how should the GASB go about deciding which note disclosures to require in the future. Usually a concept statement passes and then the amendments to other standards start following to try and get in alignment with it. We're also expecting an exposure draft on prior period adjustments. The GASB's stated preference would be for there not to be any prior period adjustments. Everything would run through the income statement, but they recognize there are times when PPAs are necessary. And so they're trying to put some guardrails around that with that standard. And then at the end of the year, we should be getting our first look at an exposure draft on additional note disclosures for risks and uncertainties, kind of generic note disclosures that say, we haven't booked a liability for this yet, but something could happen. Other projects that are on the horizon, the financial reporting model continues to plug along. If you're interested in that, the exposure draft comment deadline is next month in February. So they're working on a complete overhaul to GASB 34. We could fill a webinar just on that, but the exposure draft is still open for comment. Final standard by the end of next year, or by the middle of next year. Implementation will be 1 or 2 or 3 years after that. So we've got time. They're also working on an exposure draft for a new concept statement on recognition. When should we recognize revenues and expenses? That has been developed in conjunction with the financial reporting model and should follow many of the same themes. And the same thing's true for revenue and expense recognition. They've moved past the preliminary views stage and we're expecting an exposure draft, but not for a while. We've got another 2 years really before that hits the plate. So there's a lot on the radar that's still to come. The GASB has not taken a holiday. They're still moving away at full speed. And we should have plenty of material for our 2022 GAAP update when you join us next year. I'm looking real quick for any final questions that have come in here. So there's a question, does it matter, the criteria for a 457 plan, would it also apply to a 401A? If we have an employer making contributions with fixed rate component, could that meet the definition of a pension plan? And the answer is absolutely. The GASB has never been hung up about IRC revenue code numbers. They've always been hung up on the definition. So go back to GASB 68 and GASB 75, look at what the definition of a pension is, look at the definition of OPEB. If your plan meets them, then you would be subject to those guidance. So with that, I'm going to close things out and have our closing announcements. Thanks, everybody.
This concludes today's program. Thank you for joining us. With respect to people's time, we will reach out directly to answer any additional questions. If you'd like to learn more, please visit Rehmann's website at www.rehmann.com/government-resources. You can also email us at publicsector@rehmann.com. Thank you.